Today I would like to speak about 3 stocks that Twitter always make fun of. DraftKings, Peloton and fsly. These 3 stocks always get negative sentiment, negative comments on Twitter, and today I'm going to visit it and share my views and my research with you. So see you soon. Welcome back to Family Investment. My name is Alex Ko. So let's get straight to the first stock. Peloton. So as we know, Peloton, when I see Peloton, all I know that it's a home bike company, subscription, all I can think of is expensive, $49 a month, $2,000 for a static bike, and also who's going to use the bike after lockdown is just going to go down the drain. So fundamentally, not even going there, you think that this is a one-trick pony. Today, I've done a bit of in-depth research to understand the company a bit more, to give them a second chance, because end of the day, the stock is going up $125 a share. It's roaring, it's screaming. There's a reason why this happens. In the last 6 years, year-on-year growth is 100%. They have currently 3.6 million subscribers in America alone. Their goal, very ambitious, they've done it really well, it's 100 million subscribers. They're thinking of going global. Now they're not just bikes. People think that's bikes. It's more than bikes, okay? They've got a running treadmill. They have got yoga sets. They're linked up to your phone. They're very technological. They're changing really fast. You can see the revenue jump from 65%, 171%, and the recent earning, they were up revenue last quarter to this quarter is 232%. For a company to get IPO money and scale, it's all about scaling, lower cost, high quality, and speed. And they're doing all 4. Wall Street always look at these 4 qualities and they are just pinpointing, achieving, this is what they do, this is what they like. Wall Street loves them because they're disrupting gym. I mean, if I was a gym owner now, I'll be pooping in my pants thinking, wait a minute, I need a Peloton bike. Oh, wait a minute, Peloton's against me. Because I'm going to lose yoga classes students, I'm going to lose fitness classes students, I'm going to lose bike instructor, because everybody will be rushing to work with Peloton. So when I went to my valuation, 0.4 EPS, meaning next year they're making money, slowly breaking even. At 100% growth still, they're worth $122. That's where they are just now, 125. So people are forecasting for the next 4 months. The price that you pay just now at 125 is you are paying for 2021, making profit, same growth, breaking even. That's what you pay for. But what if 2021 and going to 2022, you start making 0.6 more profits, more revenue coming in, more subscription, more growth users? Maybe going 4 million, 4.5 million international, 0.6, a bit marginally more. The price stock will be 183 as its intrinsic value. But what if you go with 0.8, let's say in 2022, it's still growing for some bizarre reason, people are still keeping to the fitness regime. It could be worth $244. It looks like there's still room for growth if the consistency, the momentum still persists. They're not just gonna boom, stop. They're growing, they're in a momentum, they're in a forward motion. So all I can say, my final words is, holders of Peloton who still own Peloton stock, I must say, just hold it. The momentum is going, it's not gonna just, the train is not gonna just stop. So if you understand fitness, you're a fitness person, you know about the world of Peloton, the world of branding, Lululemon, Peloton, Nike, then you know, keep yourself invested. You know? And then the only time that you should let go, if you ever let go, if they ever break the barrier of that mindset of one-trick pony, you know, you just have to see the decline. If their subscription starts declining or the growth starts declining, it's very apparent. And when Wall Street sees 1 or 2 earnings on a slow decline, that's it. That's it. But who knows? This company has got huge money in the bank just now. They're scaling, they're costing, they're releasing products at speed, international growth. 2021 looks like a year that they have to keep consistency, and Peloton, you know, it's going to grow big. It's disrupting the gym. It might stop a lot of gym opening up to millennials, you know, single people without family, willing to fork out $49 for being fitness at home. Because think about it, millennials are getting fitter, they're eating healthier, they're living longer, they're very aware of what they need to do for mental health and physical health. And so well done to Peloton. And I personally will not invest in Peloton because I don't understand the business and I prefer to go in other tech area. But you know, sports plus tech is great. And honestly, in my humble opinion, I think the likes of Nike and Reebok or Adidas should buy Peloton now to be part of their huge business. I think that's where you should grow with Peloton. Okay, the second one, Fastly. Let's get quick fast facts for Fastly. Target is 42% for 2020. We're not sure what's going to happen next year, so they got 1 quarter left to prove themselves that this 42% is what they should be expecting. They have declined in Q3 quarters on the revenue based on TikTok. So I just want to say that their EPS, they've not broken even just now, but if you want to do the valuation on the fundamentals for Fastly, you check the EPS. So if they start breaking even, let's say they start breaking even in 2021, and then every quarter they make a bit of profit, 0.4, that's what I'm targeting, they should be worth about $55 a share. Okay, but what if they do gain more customer? Maybe Google or YouTube starts joining up. Who knows? Microsoft has got a new social media platform. Nobody knows. And then starts joining up, and then 0.6, they should be worth $81, round about what they're worth just now. So I think investors are forecasting that they should be making money. They should be growing still with 41%. It's a big number. So you should be making profit in the next few quarters. But what if they establish new contracts and just blow everybody away at 0.8 EPS, let's say towards the end of 2021 or 22, future value forecast for another year with that same growth rate, this should be about $108 a share. For Fastly is making profit, maintaining 40%. The downside is no debt, no more debt, no more revenue decline, no more growth decline, and then the global network cap. As you can see, the slowdown 106. They shouldn't stay there. They need to keep pushing. So you have to watch, if you're an existing holder, watch the quarterly earnings really closely, the numbers on their growth. Watch for the future customer collaboration. You hear that before earnings, and see who is likely to join with Fastly. The competition and the pricing. There have been more people complaining that Fastly's pricing and competition is way beyond what they should be worth. End of the day, it's a growth stock. If we want to put in money for them to venture out and grow big, that's what they need to do. They need to do it with the most money in the shortest amount of time, or else you can just be a $40 share and you can take the next 5 years to grow, and then you don't have to worry about competition. But that's where Fastly is now. It wants money to grow fast. It needs to prove itself right. DraftKings, let's speak about DraftKings. So DraftKings sitting at $42 a share. I must say a few good points about DraftKings here. It's got no debt. It's a technological social sport betting. Remember, in America, not every state can bet, not like the likes in the UK. You know, we can just openly go to a betting shop and bet. There's no much real license against it. And then they've got 1.2 billion cash, so investors are pouring in. Investors see a lot of future stake at it. Branding is great. US market only, still not tapped. The bad thing about DraftKings is there's not enough data. We don't have enough data evidence. COVID-19 is affecting it. There's no growth forecast. It's not making money. It's very hard to try to work the numbers for me personally. Sitting at 43, what's 42, 43? I'm trying to do some reverse engineering here. Let's say it starts breaking even, it starts making money, I don't know who, in the next 2022, 2023, and it needs a 30% growth. Breaking even 30% growth to justify that it's cost $42. Paying for the future value of DraftKings. And when I say future value, I think we're going to see post-COVID life. I'm talking about between $40 to $60. I'm talking about end of 2021 when things recover, when vaccine comes back, everything goes back to normal. 22 before it starts making money. So you know, if you're putting such money on a company, you need to wait. DraftKings, you have to be patient. And the competition is not great, and the branding in America, it's all about branding. Once you've got your branding strategy right, once you've got the name DraftKings as in household name, then you're it. So you're basically investing on a company, no debt, no growth, but you're looking ahead of time. Done my research, I'm sharing that if you hope you use this research, and join out with your own research to make a decision whether to buy, sell, hold. Alright guys, have a good time and see you in the next video.
Alright, before I say goodbye, please do like and subscribe on my YouTube channel, follow me on Facebook, and if you want, support me on Patreon as well, so I can produce content like this every single day for you guys, to give you guys value. So please do share, share this video to help us grow our YouTube channel, yeah? Alright guys, 3, 2, 1, bye bye!